Gold just touched $4,178 per ounce. That is an all-time record. The financial media calls it a bubble. Retail investors call it overpriced. And yet, central banks around the world purchased over 1,000 tons of gold per year for 3 consecutive years running. If gold were overvalued, the largest, most sophisticated reserve managers on the planet would be selling. They are not selling. They are accelerating. Here is what no one is telling you. Every major gold explosion in modern history, 1971, 2001, 2008, 2020, was preceded by the exact same sequence of structural signals. Not opinions, not predictions, a mechanical pattern. And that pattern is firing again right now. Not one signal, not two, but all of them simultaneously. This is not a story about whether gold will go up. This is the anatomy of what always happens before it moves, and why the current setup is more extreme than any prior episode in recorded financial history. If you leave now, you will miss the one pattern that the institutions are already acting on. The confusion is understandable. Every headline says the economy is holding, employment data is steady, stock markets are near all-time highs. So why would the most conservative money in the world, sovereign reserve funds, be loading up on a metal that pays no dividend and generates no yield? The answer is that you are looking at the surface of the ocean and calling it calm. But underneath, in the currents that move the actual mass of water, something enormous is shifting. The news is not lying. The news is showing you the tip of the iceberg. The structural forces beneath it, the debt compounding, the currency reserve shifts, the interest expense spiral, are the submerged mass that actually determines direction. Consider one data point. In fiscal year 2025, the United States government spent $962 billion in interest payments on the national debt. That is more than the entire defense budget, more than Medicare, more than every federal education dollar combined. And that number is projected to exceed $1 trillion in 2026 and reach $2.1 trillion by 2036. The media reports the surface. The mechanism operates beneath it. And the mechanism always moves first. The question is not what the headlines say. The question is what the institutions are doing and why they are doing it now. The immediate trigger is the convergence of 3 simultaneous conditions that have never occurred together at this magnitude. First, central bank gold purchases. In 2022, central banks bought 1,082 tons. In 2023, 1,037 tons. In 2024, 1,045 tons. In 2025, 863 tons. Still double the pre-2022 average of 400 to 500 tons per year. The World Gold Council projects 750 to 850 tons for 2026, historically exceptional by any measure. This is not one country. More than 40 central banks were net buyers in 2025. Poland alone added over 80 tons with a stated target of 20% gold in total reserves. China extended its gold buying streak to 16 consecutive months, lifting total holdings above 2,300 tons. Second, the U.S. dollar index. The DXY fell nearly 10% through the first half of 2025, its steepest first-half decline since 1973. By early 2026, the index trades around 99, down from above 109 in January 2025. Third, U.S. federal debt has crossed $39 trillion, with a projected budget deficit of $1.9 trillion for fiscal year 2026. Think of it like a cargo ship. A cargo ship does not turn fast. You cannot see the turn from the dock. But once 200,000 tons of steel begins changing direction, nothing in the water can stop it. That is what institutional money looks like when it repositions. Slow, massive, unstoppable once committed. The trigger is not a single event. It is the simultaneous alignment of 3 structural forces: sovereign gold accumulation, dollar weakness, and fiscal deterioration, all reaching generational extremes at the same moment. Each of these conditions has appeared individually before a major gold repricing. What makes this different is that all 3 are present at the same time, and at magnitudes that exceed every prior episode. The surface says stability. The instruments say something else entirely. The Federal Reserve is trapped. Not by choice, by arithmetic. Here is the trap. The U.S. government owes $39 trillion. Interest payments on that debt are running at approximately $88 billion per month, more than $22 billion every single week. If the Fed raises rates to fight inflation, the interest cost on that $39 trillion climbs higher. Every 1% increase in rates adds roughly $320 billion in annual interest costs over the next decade. But if the Fed cuts rates to ease the burden, it risks reigniting inflation and further weakening the dollar. This is the chess king with no clean moves. Every square is covered. The institution cannot move without triggering a consequence that feeds the same outcome. And what are the institutions actually doing? Follow the money, not the words. The official narrative says the economy is resilient. But the People's Bank of China has been adding gold for 16 consecutive months. Poland's central bank governor publicly stated the nation is buying gold for national security reasons. Brazil added 43 tons in the final 3 months of 2025 alone. BRICS Plus nations now hold 17.4% of global gold reserves, up from 11.2% in 2019. The dollar's share of global foreign exchange reserves has fallen to approximately 57%, the lowest level since 1994. Meanwhile, gold's share of global reserves has risen to its highest since 1991. A survey by the World Gold Council found that 68% of central banks plan to increase their gold holdings in 2026. Not hold, increase. The official statements say measured and cautious. The balance sheets say urgent and accelerating. When the words and the money disagree, the money is always telling the truth. The Fed is trapped between inflation and insolvency. Central banks are not waiting for a resolution. They are repositioning into the one asset that sits outside the trap, one that carries no counterparty risk, cannot be frozen by sanctions, and cannot be printed into existence. The structural consequence is not a crash, it is a melt. Think of an ice cube sitting on a warm surface. There is no dramatic moment. No loud break, the edges soften, the mass shrinks, and one day you look down and the cube is gone. That is what is happening to the purchasing power of the dollar, and every fiat currency running the same fiscal math. The U.S. national debt has grown from $22.7 trillion at the end of fiscal year 2019 to $39 trillion as of March 2026. That is a 72% increase in less than 7 years. The Congressional Budget Office projects the debt will reach 120% of GDP by 2036, surpassing the previous record of 106% set in 1946, the year after World War II ended. But the debt itself is not the mechanism. The interest on the debt is. In 2020, the government paid $345 billion in interest. In 2025, it paid $962 billion. By 2026, the CBO projects that number will exceed $1 trillion, and it will not drop below that level again. By 2036, annual interest costs reach $2.1 trillion. This is the minimum payment trap. The balance never goes down. The interest keeps compounding. The government is making minimum payments on a credit card it cannot cut up, and the interest alone now consumes more than defense and education combined. Gold does not rise because people panic. Gold rises because the math makes every alternative worse. When the cost of carrying sovereign debt exceeds the economy's ability to grow out of it, capital flows toward the one asset that cannot be diluted. The direction is not a prediction. The direction is what the arithmetic demands. The only question is speed, and the speed is accelerating. The closest structural parallel is the 1970s. And the current setup is more extreme in every measurable variable. In 1971, President Nixon ended the dollar's convertibility to gold. The U.S. national debt at the time stood at $398 billion. Inflation ran at 4.4%. The federal deficit was $23 billion. Gold was fixed at $35 per ounce. Over the next 9 years, gold rose from $35 to $850, a gain of over 2,300%. Now compare the structural conditions. National debt in 1971, $398 billion. National debt in 2026, $39 trillion. That is a 98-fold increase. Annual deficit in 1971, $23 billion. Projected deficit in 2026, $1.9 trillion, an 83-fold increase. Annual interest on debt in 1971, $21 billion. Annual interest in 2026, over $1 trillion, a 48-fold increase. Dollars share of global reserves in 1971, approximately 80%. Dollars share in 2026, approximately 57%, a 23 percentage point decline. Gold price at the start of the 1970s cycle, $35 per ounce. Gold price at the start of the current cycle in late 2022, when central bank buying surged past 1,000 tons for the first time, approximately $1,650 per ounce. Between March 2025 and March 2026, gold rose from $3,019 to $40,147, a 47% gain in 12 months. In the 1970s, gold peaked at $850 when national debt was under $500 billion and interest payments were $21 billion a year. Today, the debt is 98 times larger. The interest is 48 times larger. The deficit is 83 times larger. The structural conditions that produced a 2,300% move in the 1970s are present again, at multiples that dwarf the original episode. The numbers sit on the screen. No commentary is needed. The comparison is the argument. Here is what happened in 2005. Gold was trading around $440 per ounce. Financial media coverage of gold was minimal. Retail sentiment was indifferent. Most individual investors were fully allocated to equities and real estate, the narrative assets. Meanwhile, central banks in China, Russia, and India were quietly increasing gold reserves. Between July 2005 and May 2006, gold rose 50% from $440 to $660 before most retail investors even noticed the move had started. By the time the average investor read the first "Gold hits record high" headline in 2008, the price had already doubled from its 2005 level. By the time gold appeared on magazine covers in 2011, it had risen fivefold. The pattern repeats. In late 2022, gold was trading near $1,650. Central bank purchases surged past 1,000 tons. Poland began publicly targeting 20% gold reserves. China's buying streak began. The institutional repositioning was underway. The retail investor at that moment was focused on crypto, tech stocks, and interest rate narratives. Gold barely registered. Between late 2022 and April 2026, gold has nearly tripled, from $1,650 to over $4,800. The institutional player bought the mechanism. The retail investor waited for the narrative. By the time the narrative formed, the move was already made. This is not a criticism. It is a structural observation. Institutions act on math. Retail acts on emotion. The math moves first. The emotion arrives after. The question is not whether you see the current headline. The question is whether you saw the balance sheet 18 months ago, because that is where the signal was. Before we get to the signals, tell us in the comments. When was the last time you looked at what central banks were actually buying, instead of what the financial news was telling you to buy? No predictions? No financial advice? 3 mechanical indicators, instruments on a dashboard you can read yourself. Signal 1. Central bank net gold purchases. Monthly tonnage. This measures the volume of physical gold being added to sovereign reserves each month. The World Gold Council publishes this data quarterly. The pre-2022 average was 400 to 500 tons per year. For 3 consecutive years, that number doubled. In 2026, it is projected at 750 to 850 tons. What to watch? Sustained purchases above 60 tons per month signal the structural bid remains in place. The instrument reads elevated. You can check it yourself. Signal 2. U.S. federal interest expense as a percentage of revenue. This measures how much of every tax dollar goes to servicing debt. At the end of fiscal year 2025, interest payments consumed 18.5% of total revenue, exceeding the previous high set in 1991. The CBO projects this reaches 25.8% by 2036. What to watch? If this ratio crosses 20% and holds, the government's fiscal flexibility is functionally impaired. The reading on the instrument is 18.5% and climbing. Signal 3, the DXY, US Dollar Index. This measures the dollar's strength against a basket of 6 major currencies. The DXY fell from above 109 in January 2025 to approximately 98 in April 2026. What to watch? A sustained break below 96, the 2025 low, signals a trend rather than a correction. Each of gold's major historical rallies coincided with sustained DXY weakness. These are instruments, not opinions. The readings are public. The direction tells you where the mechanism is pointing. The mechanism is clear. Central banks have purchased over 4,000 tons of gold in 4 years, the largest sovereign accumulation wave in modern history. The U.S. is paying more than $1 trillion per year in interest on debt that has grown 72% since 2019. The dollar's share of global reserves has fallen to a 3-decade low. The fiscal trajectory projects escalation, not resolution. Every major gold repricing in the past 55 years was preceded by this exact combination: fiscal deterioration, dollar weakness, and institutional accumulation. The current readings on every one of those instruments exceed every prior episode. A dam does not collapse from one crack. It collapses when enough small fractures connect, each one manageable on its own. Together, they are structural. The mechanism is not a prediction. The mechanism is the math. This content is educational and informational only. It does not constitute financial advice. All data cited is publicly available from the sources referenced.